Picture this. You open your banking app on a Sunday morning and check your savings account. The balance is almost exactly what it was 12 months ago. You did not blow money on anything ridiculous. You did not go on an expensive vacation. You just lived your life, and the number is roughly the same. That should feel fine. It does not feel fine, because the coffee you buy every morning used to cost $3.10. It is now $4.75. The grocery run that used to cost you $120 every week is running $185 to $195 now. Your lease renewal just landed in your inbox and the number made you read it twice. Your car insurance went up. Your utility bills went up. Your streaming subscriptions went up. Everything around you got more expensive, and your savings balance just sat there looking the same. Here's what actually happened. Your savings account did not stay the same. It went backwards, and a tax you never voted on, never signed a form for, and never received a single bill for has been collecting from you every single day of your adult life. By the end of this video, you will understand exactly why keeping money in a savings account is not saving at all. It is losing in slow motion, and you will understand who collects this tax, who benefits from it, and what you can actually do to stop paying more of it than you have to. If that sounds like something you should have been told a long time ago, hit subscribe. Let's get into it. Let's start with what inflation actually is, not the textbook definition, the real one. Every single year, every dollar you own loses some percentage of its ability to buy things. The dollar bill in your wallet looks exactly the same. The number in your bank account looks exactly the same. But what those dollars can actually purchase shrinks quietly, automatically. Every year without exception. That is not a side effect of the economy. That is a feature of it. And functionally, it operates exactly like a tax. Nobody sends you a bill. Nobody asks for your signature. A percentage of your purchasing power is simply collected from you annually and redistributed to people and institutions that own things rather than hold cash. The Federal Reserve has an official target inflation rate of 2% per year. 2% sounds harmless. 2% sounds like rounding error. But 2% compounded over time is not harmless, and it is not rounding error. It is a slow, systematic transfer of wealth from people who save cash to people who own assets, and it has been running on your money since the day you opened your first bank account. Here is the math, and I want you to actually sit with these numbers for a second. You have $100,000 in a savings account. Inflation runs at 3% this year, which is not unusual and is actually below recent averages. Your savings account pays you 0.5% interest because that is roughly what most standard savings accounts pay. At the end of year one, your balance reads $100,500. You made $500 in interest. You feel fine, but inflation took 3% of your purchasing power. That is $3,000 worth of what your money could buy, gone. Your net real return is negative $2,500. You gained $500 on paper and lost $3,000 in reality. The account went up and your wealth went down simultaneously. Now run that forward. In year two, inflation erodes the purchasing power of your new, slightly larger balance. The erosion compounds the same way interest compounds, just in the wrong direction. After 10 years of 3% inflation with your money sitting in a standard savings account, your $100,000 has grown to approximately $105,000 on paper, but its purchasing power has dropped to roughly $74,000 in today's dollars. You lost nearly $26,000 in real wealth while watching your balance go up. After 20 years, the purchasing power of that original $100,000 drops to approximately $55,000 in today's dollars. You held on to your money. You did not spend it recklessly. You did not make bad investments. You just saved it. and inflation taxed away nearly half of its value while your balance showed a slow, steady rise. That is the theft. That is what the hidden tax looks like in a spreadsheet. Now here is the part that most people never think about. Who collects this tax? Because every tax has a collector. Inflation redistributes wealth. It does not destroy it. When your purchasing power erodes, that value does not disappear. It transfers. It transfers to the people and institutions that own real assets. Real estate, stocks, commodities, businesses. When inflation runs at 6%, the person who owns a house watches their asset appreciate. The person holding cash watches their cash shrink. Same inflation rate. Completely opposite outcomes depending on what you own. Governments also benefit from inflation in a way most people never realize. The United States currently carries around $36 trillion in national debt. When inflation runs, the real value of that debt shrinks. The government borrowed dollars that were worth more and gets to repay them with dollars that are worth less. Inflation is the quietest debt relief program in history, and it runs on the savings of people who are too busy living their lives to notice. Debtors win. Asset owners win. Governments win. Cash savers lose. Every single time. Here is where the hidden tax shows up in your actual daily life and why it is so effective at staying invisible. Shrinkflation. You have noticed this even if you did not have a name for it. The bag of chips that used to weigh 12 ounces now weighs 9.5 ounces. Same bag, same price, same shelf, but you are getting 20% less product. The company did not raise the price. They lowered the amount. The hidden tax collected in the form of fewer chips, and most people never registered the change. Wage erosion. Your salary went up 3% this year. You got the raise. You felt good about it. And then inflation ran at 5.5% for the year. Your nominal wage went up. Your real wage went down 2.5%. You are working the same job, putting in the same hours, and your actual purchasing power declined. You got a pay cut disguised as a raise, and your employer did not have to have a single difficult conversation to deliver it. Savings account theft. The national average savings account interest rate sits around 0.5%. Inflation averages between 3% and 4% over long periods. Every day your money sits in a standard savings account, you are losing purchasing power at a guaranteed rate. The account says you are saving. The math says you are losing. You are paying the hidden tax at full rate every single day. You leave money there. Rent compounding. Your landlord raised your rent 6% this year. Last year, it went up 5%. The year before, 4%. Each increase is applied to a base that already reflects all previous increases. The compounding works exactly the same way as investment returns, just against you instead of for you. So what do you actually do with all of this? First, understand the difference between nominal returns and real returns. Nominal is the number your account shows. Real is what that number can actually buy. A savings account showing 4.5% interest during a 4% inflation period has a real return of 0.5%. Barely treading water. An investment returning 8% during a 3% inflation period has a real return of 5%. That is actual wealth building. Always ask the real return question. The nominal number is what the financial industry wants you to look at. The real number is what actually matters. Second, assets beat cash over every meaningful time horizon. Stocks, real estate, and commodities have historically outpaced inflation over long periods because they represent ownership of real things whose value rises with prices. Holding cash feels safe. Holding cash during persistent inflation is one of the most reliably wealth-destroying decisions a person can make. Safety is an illusion when the value of what you are holding shrinks every year. Third, the government sells inflation insurance and almost nobody buys it. Series 1 savings bonds adjust their interest rate with inflation automatically. In 2022, they paid 9.62% when inflation was running hot. Tips: Treasury inflation protected securities. Do the same thing inside retirement accounts. These are not exciting investments. They are not going to make you rich, but they will stop the hidden tax from collecting on the portion of your money that needs to stay safe and accessible. Fourth, stop measuring your wealth in dollars and start measuring it in purchasing power. Ask yourself not how much money you have, but what that money can actually buy today compared to 2 years ago. That question is uncomfortable. It is supposed to be. It is the only honest measure of whether your financial position is actually improving or whether you are running in place on a treadmill that is moving backward. Go back to that Sunday morning, the savings account with the same balance as last year. You thought nothing happened. Something happened. The hidden tax ran its annual collection cycle. The purchasing power of every dollar in that account quietly declined. The coffee got more expensive. The groceries got more expensive. The rent got more expensive. And the account just sat there looking fine while your actual financial position moved quietly in the wrong direction. You were never saving. You were losing at a rate slow enough to feel like standing still. But you know the name of the tax now. You know who collects it, who benefits from it, and what it has been doing to your money since the day you started earning it. And knowing the name of something is the first step toward stopping it from collecting from you in silence. The hidden tax does not stop running, but now you know it exists. And the people who know it exists are the only ones who have any chance of outrunning it.